So now the big question, should you lock in your rate or float into next week? Well, if you're already under contract and your current pricing works, this might be a good time to lock. Well, while we hit the best levels in nearly 6 months, that's not something to take for granted, especially when the market is this jittery. But if you're still house hunting and you've got some flexibility, there's a chance we see more downward movement, especially if next week's economic data comes in soft. But know that the risk goes both ways. One hot inflation report or one geopolitical twist, and we could be right back above 6.75% in a blink. So what's coming next week? Well, next week is also going to be crazy, so buckle up, everybody, and watch out for this data. Tuesday brings the NIFB Small Business Optimism Report and Consumer Credit, both of which could hint at where the economic confidence stands. But the real focal point is when we get to the Consumer Price Index, or CPI. This is the market's favorite inflation report, and it's coming at a critical time. If CPI comes in hotter than expected, it could shatter this week's bond rally and force mortgage rates higher. But if inflation softens, we could finally see rates dip closer to that magical 6.5% territory. And remember, lenders have different rates. So rates could very well drop into the low 6s or high 5s. Thursday brings Producer Price Index, or the PPI, which measures wholesale inflation. Now, it doesn't carry the same weight as a CPI, but it adds context. And Friday, we close the week with the University of Michigan's Consumer Sentiment Report, a key gauge on how people feel about inflation and the economy in general. But the bottom line is, this week was a technical win for rates, but next week will test whether that win has any staying power. So what's your move? Are you playing it safe, locking in those low rates now, or are you hoping next week's data delivers a little more fuel for this rally?